You've been promised holy grails, back-tested systems, and secret indicators. You've spent countless hours staring at charts, convinced that one more technical tweak is all that stands between you and consistent profits. But what if I told you the reason most traders fail has almost nothing to do with their strategy? The best traders I know don't have a crystal ball. They have a secret weapon, and it's pointed directly at their own worst enemy, their emotions. The statistics are brutal. Depending on the study you look at, somewhere between 90% and 95% of day traders lose money and eventually quit. Some data shows that even at top-tier prop firms, only about 5 to 10% of traders can pass the evaluation challenges, and even fewer actually see a payout. These aren't just numbers, they're shattered dreams and empty accounts. The devastating truth is that most traders fail not because they're unintelligent or their strategies are bad, but because they're human. They fall for the exact same psychological traps that have plagued markets for centuries. Today, we're going to expose why your own mind is the biggest obstacle to your trading goals. And more importantly, I'm going to give you the blueprint for building a simple, powerful mechanical system that takes your emotional, self-sabotaging brain out of the driver's seat. Let's be honest, does this sound familiar? You find a new strategy. It looks incredible. The backtest is a thing of beauty. You take your first couple of trades, and they're winners. You feel that rush of euphoria, a surge of confidence. You think, this is it. I've finally cracked the code. Your confidence swells, and on the next trade, you bend the rules, just a little. Maybe you add a bit more size than you should. Maybe you jump in early, terrified of missing out. And then, the trade turns against you. That small, manageable loss you planned for starts to grow. Panic creeps in. The logical part of your brain that designed the trading plan is now being drowned out by a primal scream of danger. That carefully placed stop-loss? You nudge it down just a bit, telling yourself, it's going to turn around. Just give it room to breathe. But it doesn't. The loss gets bigger. Now fear has morphed into a desperate, praying hope that you can just get back to break even. Finally, the pain is unbearable, and you capitulate. You close the trade for a catastrophic loss that wipes out all your previous wins, and then some. In the aftermath, you're furious. You're filled with regret. And who do you blame? Not your lack of discipline. Not your emotional roller coaster. You blame the strategy. You tell yourself it's flawed, that it stopped working. And so the cycle begins again. You trash a perfectly good strategy and go hunting for the next holy grail, the next system that promises wins without the emotional gut punch. This is the internal battle every single trader faces, and it's the number one reason for failure. The market doesn't defeat you, you defeat yourself. Behavioral finance experts agree that the vast majority of trading mistakes are driven by emotion, not a bad strategy. Neurologically, a trading loss lights up the same pain centers in your brain as a physical threat. Your amygdala, the brain's survival alarm, hijacks your logical prefrontal cortex. You stop being a trader and become a cornered animal, fighting for your life. This is why you make irrational decisions you'd never dream of making in a calm state. You could have the most profitable strategy on earth, but if your psychology is weak, you will lose money. On the flip side, a trader with a mediocre strategy but ironclad discipline can, and will, be profitable. The problem isn't your chart, it's the person staring at it. This isn't just a bad habit, it's a destructive, self-perpetuating loop. I call it the vicious cycle of trading madness, and it traps millions of traders, draining their accounts and their sanity. It has predictable stages that feed on each other, creating a downward spiral that's almost impossible to escape without a major shift in your approach. Stage 1, the winner's high. It starts with a win, or a few. You follow your new strategy, it works, and you make money. Your brain is flooded with dopamine. It feels good. Too good. You don't see this success as a probable outcome of a good process. You see it as proof of your genius. You start to feel invincible. This isn't confidence, it's overconfidence, a bias that makes you think you can't lose. Stage 2, reckless rule bending. Fueled by that high, you start to drift. Your discipline crumbles. Why stick to a 1% risk rule when you're sure this next trade is a guaranteed winner? You crank up your position size. Why wait for the perfect entry when you can feel the market is about to pop? You jump in early, driven by pure FOMO. You're now making decisions based on feelings, not rules, completely abandoning the process that brought you success in the first place. Stage 3, the shock of loss. The market, which has no idea who you are, does what it always does. It fluctuates. The trade you were so sure about turns against you. And because you use too much size, the loss is bigger and more painful than it should be. The dopamine high vanishes, replaced by a spike of cortisol and adrenaline. The shock is jarring. It feels like a personal betrayal. Stage 4. The losing battle of hope and fear. This is where the real psychological damage happens. Nobel Prize-winning psychologist Daniel Kahneman proved that humans feel the pain of a loss about 2.5 times more intensely than the pleasure of an equal gain. This is called loss aversion. A $1,000 loss hurts more than twice as much as a $1,000 win feels good. This one neurological fact explains the disastrous decisions that follow. Your brain will do anything to avoid the pain of realizing a loss, so you hold on, hoping for a miracle. At the same time, fear dominates your winning trades, making you snatch profits early before they can disappear. You do the exact opposite of what you should. You cut your winners short and let your losers run. A famous brokerage study of 43 million trades found that even though traders were winning on over 60% of their trades, most still lost money. Why? Because their average loss was far bigger than their average win. Stage 5. Revenge and blame. After you finally take that devastating loss, you're consumed by anger. You feel like the market owes you, and you want your money back now. This leads to revenge trading, jumping right back in with an impulsive, oversized trade to try and make it back. This is pure gambling, and it almost always leads to more losses. Once the dust settles, you look at your depleted account and conclude the strategy failed you. You never think, I failed because I broke my rules. And just like that, you're back at square one, looking for a new system, totally blind to the fact that you are the saboteur. The longer you stay in this cycle, the more you reinforce these destructive neural pathways. You're literally training your brain to fail. This is why so many traders with years of experience are no better off than when they started. They haven't been trading for 5 years. They've been repeating the first 3 months of failure 20 times over. To break free, you have to accept a simple, counterintuitive truth. Successful trading isn't about predicting the future. It's about executing a system with a positive edge over and over again. You have to stop thinking like a market guru or a gambler trying to guess the next move. You need to start thinking like a casino owner. A casino doesn't know if the next spin of the roulette wheel will be red or black. It doesn't care. It doesn't get emotional when someone hits a big jackpot. Why? Because the casino knows that over thousands of spins, its small built-in statistical edge, the 0 and 2000, guarantees it will make money. The casino runs a mechanical system. It relies on math and discipline, not luck. This is the shift you have to make. Your trading strategy is your small statistical edge. But a strategy by itself is just an idea. A trading system is the framework that turns your strategy into a repeatable, rule-based process. It removes the ambiguity, the guesswork, and most importantly, the emotion. A system forces you to become the casino. It answers every critical question before you enter a trade, leaving zero room for emotional debates in the heat of the moment. What are your exact entry conditions? What's your exact stop loss? What's your profit-taking logic? How much will you risk? These aren't vague guidelines. They are ironclad rules. When you have a true system, you're no longer making decisions during the battle. The decisions have already been made. Your only job during market hours is to execute. That's it. This is how you remove psychology from the equation. It isn't about suppressing your emotions. That's impossible. It's about creating a framework so clear that your emotions become irrelevant to your actions. The fear will still show up. The greed will still whisper in your ear. But they no longer have control of the buttons. Your system does. All right, let's move from the why to the how. We're going to build the components of your mechanical trading fortress. A set of rules so clear they leave no room for self-sabotage. This isn't about me giving you a holy grail strategy. This is about giving you the blueprint to build your own system. A mechanical system means executing the same setup every time, relying on strict consistency and smart money management to get profitable over the long haul. Your edge comes from the disciplined repetition of a tested process across hundreds of trades. Our fortress has 5 main walls. Objective entry triggers, the rules for getting in. Predetermined exits, the rules for getting out. Rigid position sizing, the rule for how much to risk. Systematic risk management, the rules that protect your entire account. Documentation and the walkaway. the process of logging your actions and removing yourself. Wall number 1, objective entry triggers. Your entry rules have to be black and white. A simple yes or no. No room for interpretation. An emotional, subjective rule sounds like this. Buy when the price looks like it's bouncing. Sell if it feels like momentum is slowing. What does looks like or feels like even mean? These are open invitations for your emotional brain to take over. An objective, mechanical rule sounds like this. If the 20 EMA is above the 50 EMA and the RSI 14 crosses above 50 and the current candle closes as a bullish engulfing candle, then a buy signal is triggered. If the price is in a range for at least 10 bars and it breaks below the low of that range on above average volume, then a sell signal is triggered. See the difference? These rules are testable. 10 different traders could look at the same chart and identify the exact same entry point. No ambiguity. You are not allowed to place a trade unless your objective criteria are 100% met. No exceptions. Wall number 2, predetermined exits, the liberation of stop losses. This is where the biggest psychological war is fought. A mechanical system liberates you from this hell. Your exit points for both a loss and a profit are defined before you ever click the buy or sell button. The non-negotiable stop loss. Your stop loss is not a suggestion. It is the pre-agreed point where your trade idea is proven wrong. Once you place it, you never, ever move it further away. Moving your stop to accommodate a loser is the fastest way to blow up your account. Set it mechanically. Structure-based. Place it just beyond a recent swing high or low. Volatility-based. Use a measure like the average true range ATR. For example, your stop is 2x the current ATR value away from your entry. The key is to pick one method and use it every single time. The trade is over when the price hits your stop. You take the loss as a business expense and move on. The mechanical take profit. Just as fear makes you hold losers, greed makes you mismanage winners. Mechanical profit targets solve this. Risk-reward multiples. This is the simplest and often best method. If your stop loss is a 1R loss, set your take profit at a 2R or 3R gain. If you risk $100, your target is a $200 or $300 profit. This mathematically ensures your average win is bigger than your average loss. Structure-based. Target a previous, major level of support or resistance. Once the trade is live with its hard stop loss and take profit orders in place, your job is done. You can and should walk away. Let the market decide the outcome. The rest is just noise. Wall number 3, rigid position sizing. This is, without a doubt, the most overlooked yet most powerful part of any trading system. This is how you decide how much money to put on a single trade. Most traders either trade a fixed number of shares or, even worse, vary their size based on how confident they feel. Both are recipes for disaster. Mechanical position sizing is based on math, not emotion. The goal is to risk the same, small percentage of your account, typically 1% to 2%, on every single trade. The formula is simple but profound. Let's make this real. Imagine a $10,000 account and a strict 1% risk rule. Your account risk is $100, $10,000 asterisk 0.01. This is the absolute most you can lose on one trade. It's your 1R. Your system gives you a buy signal on a stock at $50. Your rules say the stop loss goes at $47.50. The distance to your stop is $2.50 per share. Position size equals $100/$2.50 equals 40 shares. For this trade, you buy 40 shares. If you get stopped out, you lose exactly $100, your plan. Now, the next trade is on a more volatile stock. The entry is $120, and the stop is at $114. The distance is now $6 per share. Your 1% risk is still $100. New position size equals $100/$6 equals 16.66, so you buy 16 shares. You buy fewer shares because the risk per share is larger, but your dollar risk remains constant. This is revolutionary. You stop thinking in pips or points and start thinking in R, your fixed unit of risk. This smooths your equity curve and prevents any single trade from crippling you. It also acts as a hidden profit multiplier. As your account grows, your 1% risk amount grows, allowing you to buy more shares and compound returns faster. Wall number 4, systematic risk management. This wall protects your entire fortress, your capital. Maximum daily loss. have a hard stop rule. If I lose 2% of my account today, I am done trading for the day. Period. This prevents you from revenge trading your account to zero. Maximum weekly loss. Have a similar rule for the week. If I'm down 5% for the week, I shut it down until Monday. This saves you from bad market conditions and from your own poor performance. Drawdown management. Know your system's historical drawdown from backtesting. If your system historically had a 20% drawdown, you won't panic when you're down 15%. You'll know it's part of the process. Wall number 5, documentation and the walkaway. First, documentation. Keep a detailed trading journal. Log the date, asset, entry, stop, profit target, the R multiple result, and a screenshot. Most importantly, answer one question. Did I follow my rules 100%? This log is your accountability mirror. It will show you whether your strategy is the problem or your discipline is. Second, the walkaway. This is the final act of discipline. Once your trade is placed with its stop and target, your work is done. Walk away from the screen. Don't sit there watching every tick. That's just inviting your emotional brain to meddle. Go for a walk, do your job, live your life. You have to detach from the outcome of any single trade. One trade is random. The outcome of the next 100, executed flawlessly, is a statistic. Trust your system. We've gone deep into why so many traders fail, and the answer is simpler than most realize. It's not the magic indicator. It's not the secret strategy. The battle for trading success is fought in the 6 inches between your ears. The failure rate is high not because trading is impossible, but because most people are wiped out by their own emotions before they ever get a chance to get good. The enemy is your own human nature. The wiring that makes you fear loss more than you enjoy gain. The hope that keeps you in a losing trade. The greed that ruins a winner. But the solution isn't to become a robot. The solution is to build a better process. It's accepting that you can't predict markets, but you can control your actions. You do this by building a mechanical trading system, a set of non-negotiable rules for your entry, exit, and risk on every single trade. This system is your fortress. It shields you from fear and greed. It turns trading from a chaotic gamble into a calm, methodical business. Your job is no longer to be a hero predicting the future. Your job is to be an operator who executes a plan. You become the casino, not the gambler. The path to consistent profits isn't glamorous. It's a journey of discipline and radical self-awareness. It's about having a plan and, more importantly, having the discipline to follow it, especially when it's hard. So stop searching for the perfect strategy. That search is the symptom. Turn your focus inward. Commit today to building your own mechanical system. Define your rules, quantify your risk, and execute. That is the true holy grail. That is what separates the many who fail from the few who succeed.